Welcome. You are listening to Purpose Driven Wealth, the podcast for empowered investors. If you're an investor who is tired of playing the Wall Street casinos, stay tuned. On this show, we bring on industry experts to discuss leading strategies to help you make empowered decisions with your hard-earned capital. And now, here is your host, Bina.
Welcome to Purpose Driven Wealth, the podcast show for empowered investors. I'm your host, Bina. Today on the show, we have Kevin Valley. Kevin is a capital raiser who specializes in helping medium-sized businesses with annual revenues of up to $25 million to attract the funding they need to scale. With over 12 years of experience in corporate and investment banking, Kevin is a chartered business valuator and the founder of Become Investible. Welcome, Kevin.
Thank you, Mo. Glad to be here.
So let's dive into it. Sure. So Kevin, your background is in private equity. Can you help the listeners understand a little bit what is private equity, and perhaps if you could also maybe get into some of the unique elements of how private equity operates in Trinidad versus maybe how it kind of functions maybe in the United States?
Okay, I guess at a rudimentary level, private equity is investing in private companies. So you buy shares or equity in a private company. So this is a bit different from, like, say, invested in real estate or infrastructure. So those can be other private investment asset classes, but private equity focuses on investing in private companies. Because we all know there are two ways to finance a company. There's debt and then there's equity. So yeah. Okay, and you asked about unique elements to how the private equity environment operates in Trinidad versus in the US? Yeah? Yes. Okay. Yeah. So, well, to be honest with you, private equity in Trinidad in particular is in its very nascent stage. So my company, Aspire Fund Management, is actually the only real player here. There are a couple angel investor groups, but in terms of actual like institutionalized private equity, we're the only ones here. In Jamaica, there are quite a few of them there. They're a little bit more advanced than us in terms of private equity and investing in private companies across there. How we differ from the US now? US is a quite vast and quite larger market than Trinidad and Jamaica, even the Caribbean as a whole. So it's definitely more competitive in the US. And in terms of the transaction structures, I've seen a couple term sheets from the US. They could be like 7 to 10 pages long. There's a lot of bells and whistles in terms of how they structure the deal, be it ratchet agreements or what have you, just to ensure that they get back their capital and get their return on capital. We like to approach things a little bit more simple, because you have to remember that the issuers, the companies who are seeking financing, aren't necessarily as sophisticated. So we don't want to give them a term sheet and then they, it's like, oh, they need to hire somebody so they can understand their term sheet. So we try to keep it simple, but we try to tailor make it just to make sure that we protect our risk, enhance our return, and make sure that it's a win-win for both us and the issuer.
It totally makes sense. And what do you see as the potential growth of private equity in Trinidad? Has it been fairly level over the last 5 to 10 years? And where do you see it projecting in terms of growth moving forward?
So I'll tell you how most of the wealth has been created in Trinidad, right? So most of the wealth in Trinidad, I mean, yes, we do have a business sector. A lot of family businesses, they would have started up and they transition, and in many communities, but a lot of it is real estate. So the average Trinidadian high net worth investor, they are accustomed to getting that, those kind of cash flow. They like to invest based on cash flows, right? So debt is also pretty popular here. Bank financing is the first clutch that people go to. But you mentioned that I specialize in medium-sized companies, right? So medium-sized companies, it's a little tricky for them to attract bank financing. So when they go approach an investment bank, the investment bank takes them to the capital markets, and usually the institutional investors in the capital markets, they want to make sure that they have their cash flows coming in, so they prefer debt than equity. We try to get them in a little bit with some preference shares and coupon payments, so regular dividend payments or whatnot. Not coupons, sorry, dividend payments. But yeah, so all in all, it's a very debt / cash flow / real estate investment market, and we keep trying to show them the benefits of entrepreneurship and investing in private companies.
Interesting. And so, are these mainly, if I heard you right, were these mainly kind of like family offices or kind of like larger pools of money that are within like families, I guess, and they're just kind of looking for more stable type investments at cash flow versus kind of maybe more riskier but higher appreciation potential investments like in entrepreneurship or startup companies?
Yeah, very. So I would say the latter, not necessarily family offices. There are a couple family offices, but those are actually institutionalized in a sense, and they will direct their. And it's funny, right? The managers that we found of those family offices would more direct those companies into private debt and to some publicly traded stocks, mostly in the US, because the Trinidadian stock market is actually somewhat illiquid and it's still very young in a sense.
What do you mean by illiquid? Does it not trade, or is there does it not trade daily, or does it trade daily but there's not a lot of float in the exchange? Or
so the volume is very low in terms of the velocity of how frequently these stocks are traded, so, and it's a small percentage of the population that gets involved in the stock market per se. I think like the biggest events are when they have like IPOs or so, because IPOs are heavily marketed, because IPO is also a big PR is like a big PR campaign. Course, they say, oh, I need to get a piece of that, so institutionals, individuals and everything, they chase down the IPO, but it's very thinly traded stock market here.
Oh, interesting. I didn't know that.
But funny enough, I mean, I mentioned Jamaica earlier. So Jamaica has been able to win awards for the best performing stock market in 2018 and 2019 because they approach things a little differently, right? So that country actually had a lot of debt. Like I'm talking about debt to GDP ratio, something like 150 or 150%. Yeah, it was pretty high, and they were. Yeah, the IMF kept knocking at their doors, and they made a countrywide decision, also kind of led by their Minister of Finance, to let's invest in ourselves, right? Let's invest in our private companies here. And so you see, like I talk about IPOs here, they probably had about 40. There were probably about 40 something companies listed on a junior exchange. They have IPOs going on almost every other month. They're about maybe about 6 or 7 different companies who are competing to underwrite the IPOs, who are competing to be the lead brokers for these IPOs and stuff. So it's a completely different market. And by doing that, they're able to get their debt to GDP ratio less than 1, maybe about 80 something, 90% or so. And yeah, it's like the last time I was there, like the man on the street has a portfolio, so it's a completely different market there.
Oh, that's interesting. So they've been able to drop their debt to GDP from, I think you said, what, 150% now to like 80, so like almost in half. Wow, that's a big difference.
Yeah, just by investing themselves. You see, the Trinidadian market, we were kind of spoiled because we have oil as a natural resource. So we would have made a lot of our wealth by exporting oil to the various nations. But now that the oil price has been kind of volatile, at best, right? So we see a lot of layoffs in the energy sector, in our oil and gas sector and stuff. And now we feel the pinch of not being diversified as an economy before, and this is why I go on platforms and I advocate for investing in private companies and in making companies stronger and more attractive to be invested in.
That's great, and we're definitely going to get to that in a few minutes. We're definitely going to touch upon that. So that was a great overview on Trinidad, and also kind of like even more like how it kind of works economically as well too. So that was great. So You're a chartered business valuator. Can you explain exactly what that means and what do you do as a result of that?
Yeah, I mean, I've been told to toot my horn. I don't like to toot my horn, but I'm
Please
actually
do. Please do. This is your time.
So it's my time, right?
Yes.
Okay, so I'm actually the only chartered business valuator in Trinidad. The only person with that qualification. There are a few in Jamaica. There are a couple in Barbados. I think there's one in St. Vincent. You know, in terms of the Caribbean region, and maybe two or so in the Cayman Islands, right? So the chartered business valuator program. This is I would consider it to be a rigorous program because I mean I didn't pass each course on my first try. I'm not going to lie about that, But you complete 4 core valuation courses. So they go everything from understanding the various methods to do valuation, understanding how you do comparable company valuation, the intricacies of minority discounts, illiquidity discounts, blockage discounts, and all of that. Then you get advanced as structuring different classes of shares. So you spoke about preference shares and the different features and rights and how those impact valuation, and you talk about convertible debt, warrants, all those others, things like that, as well as you actually speak about doing damages calculations in litigation circumstances. So be it personal injury, be it expropriation, where the government is taking the land in which your business was operating, so you need to be compensated for that. Be it, let's say you have the wrongful actions of somebody else has caused lost business to you. Yeah, so that's part of the curriculum as well. And I did two electives called corporate finance and private investments, just because those are my passions, and then we had membership qualification exam, which to me was more like a race than an exam, because you have 4 hours to do these full and heavy valuations, and you're scored more on how much you're able to complete rather than, I would say rather than, but that is more of a time pressure than a technical pressure to me.
Wow, that's really interesting. So you mentioned you're the only one in all of Trinidad. So is that something that obviously sounds like that's very unique and a very fine niche? Does that bring a lot of opportunities, I guess, in terms of being a business evaluator like that? And I mean, if I was the only one in my country that did something, I think that'd be fairly unique. So I'd like to hear some more about that.
To be fair, yes, I'm the only one certified in it, but I'm not the only one who could practice it. So the professional service firms, we have the big 4 here. We have the EY, we have the PwC, KPMG, Deloitte. So those guys do valuation engagements. They are staffed by people who may have masters, maybe some may have done CFA, some accountants or whatnot. But yeah, so in terms of my space, so those guys will be handling more of the larger companies who could afford their bills. I specialize more in the medium space, making between 1 and 25 million US in revenues or so. I mean, my overheads are pretty low. I mean, you're looking at my overheads right now. This is my office right here. Yeah. So, but yeah, I do get some business. I work again with the private equity company I work with. I do their valuations. The investment bank I used to work with, KCL Capital Market Brokers. I do valuations for them as well when they're looking to raise equity capital for one of their clients for their clients. And I've also attracted business regionally. So as far as Barbados, Jamaica, wherever, people approach me for valuation work, because a lot of times people want to work with somebody who's independent of a big 4 firm or whatnot, so yeah, I do okay.
Nice. So let's talk a little bit about what are the different ways or methods, and I think you may have touched upon it a little bit already, but the ways and methods how you go about in terms of like valuing a business.
Yeah, sure. Okay, so I mean, valuing a business pretty much, like valuing real estate or whatnot. There are 3 different methods, right? 3 main principal methods. So you have your income approach, which is based on what you expect the company to make in terms of income, in terms of cash flows or whatnot over the future in an indefinite period, or for as long as you're looking to hold the investment. Then you have the market approach. So what are similar assets or similar companies trading at? Right. And also the market approach might have like different rules of thumbs depending on the industry or depending on the stage of the business. So for example, for young companies that'll be funded by venture capital firms, they may have a scorecard approach, and there are a variety of scorecard approaches where they kind of use a matrix to value companies based on different features. I don't love that too much because it seems a little bit too much like this pure. It just seems kind of it's not very fundamental to me, and I'm a big fundamentalist.
Gotcha.
Right? And the other is the cost or the asset approach. So how much did it cost you to build this asset, or what will it cost me to go and replace this asset if need be?
Okay, that makes sense. Yeah, and I guess like in real estate, like it's really kind of the same thing, right? It's the income approach where you're basically calculating, what are the income and what are the expenses, and in the case of real estate, what's the net operating income, and then applying a cap rate to that.
Yeah, correct.
And then like you said, the cost. The cost asset approach. So you're just trying to figure out, hey, what is the replacement cost if I were to go and, in the case of a building, I want to build this up I want to build it from the ground up. Or in the case of a business, what if I want to build this business from the ground up? How would I do that, and how much is it going to cost? And also, like you said, the market approach. What are the sales comps? Like or similar as much as possible businesses, in the same industry and so forth. And
exactly.
So, yeah, it's very, very similar to industry. I mean, obviously, these are three fundamental ways of valuing just about everything that, at least that I know of. I mean, maybe there's some nuances as well too, but like I said, these are the three main approaches. So does the size or the industry of the business matter when you're doing these valuations? So like, would you approach a smaller business versus a larger one in terms of how you value?
Yeah. So, all right. So in terms of, valuation is based on two main factors. I mean, I know we spoke about three different methods of valuing, right? But it's based on two main factors, and that's risk and growth, right? Growth is captured in, again, when you're doing your income approach and what sort of cash flows you expect them to achieve, what sort of growth you expect them to achieve. Risk is where you have a lot of the nuances. Is where you price in a lot of the nuances, right? So for me, when I'm doing a valuation of a company, I'm using an income approach or so. I would build up the discount rate, right? So again, the value of the company would be whatever's their free cash flow or the present value of their free cash flows divided by, discounted at a rate to recognize both risk and what return an investor would want for that level of risk. Right. So the risk will be built up of the risk-free rate. What is the industry risk premium? So different industries have different levels of risk. You have a size premium as well. So if you're a small company versus a large company, there are different levels of a premium that you would use based on the size of the company. What's its asset base, or what level of revenue it makes, and where the valuator gets to have a lot of wiggle room is in the company specific risk premium, right? So that is where we look at the company's business setup, its business model and everything. And that's where we get into the nuances of, okay, what makes this company a better company than the company selling a similar product next door or in another market, right? So that company specific risk premium, it could range from as low as 3%, it could go all the way up to 10, 15%, depending. And also if the company has ridiculously aggressive forecasts, we might price that in as well as modeling risk.
Interesting.
So no, I mean, the song is very technical and stuff, but it could be fun.
Oh, for sure. Like
you could have fun in Excel.
Oh, exactly. That's what I was actually thinking, when I was in college and I took classes on statistics, and I even took classes on probability and also like decision analysis. And so when you take, classes like that, the hardest part, especially when it came to decision analysis is, how do you quantify risk? I mean, because there's so much variability. Obviously, you're trying to quantify something that's unknown, but you have some idea about it. And so I'm kind of interested to hear now, like, how do you approach that? Because I can imagine that in some cases, like some of these values, or let's say some of these percentages that you come up with in terms of, quantifying risk, they can ultimately make huge differences in the overall valuation. Or maybe that isn't quite the case. Maybe because you have so many inputs that it's done in such a way where it kind of minimizes any one particular risk category. But I'd love to hear more about that.
Yeah, sure. And what I also do is I don't give a valuation as a one spot valuation, right? I like to do it in a range,
Okay.
Yeah. So you might say, okay, this company's risk premium might be in a range of 5 to 7%. Their sustainable growth rate might be in the range of 1 to 2%. That sort of thing. So usually, yeah, you'll end up with a valuation range of X to X million or what have you.
Okay, that totally makes sense now. Yeah. So basically now you've accounted for the uncertainty, I guess, with assigning, values to different risk categories. That totally makes sense. And so what do you do, like, in terms of like growth? Because you mentioned that risk and growth have to be accounted for. And obviously if it's an established business that's, pretty stable, growth is probably, I would say, fairly minimal or easy to kind of estimate. But what do you do in the case of it's a startup, and let's say if it's especially if it's in a tech space and they're estimating something quite a bit different than maybe someone else would, because obviously anyone who's part of the company or that's part of the operation, they're going to want to see themselves as, yeah, we're going to reach all of our goals and some. And of course you want them to think that, because if they didn't, then, why would you want to invest with them, or why would you want to be associated with them if they didn't think so highly of themselves and their future prospects? But in terms of, on your end, in terms of valuing a company like that, how do you kind of tamper or kind of dampen that enthusiasm they may have in terms of growth projections?
Yeah, listen, I love that question. I really, really, really love that question. And it is a question like that, issues like that is actually what keeps me up at night. Many times just there, sit down on my laptop saying, okay, what makes sense here? Right? Because, all right, so let's look at two different scenarios, right? Let's say you have a existing company with maybe a little bit of track record, but it's still, their growth projections are still way out there, right? You could toggle their company specific risk premium to account for that. And also what I did recently, you could add a probability weighting adjustment to their projections. Right? Especially if it's a younger company and they haven't really proven anything yet, especially in a tech space. Actually, I literally just did that with a fintech company that's maybe a year old, but the projections were very aggressive, and it was based on, being, well, I don't want to go too deep, but it was based on being acquired by somebody, and based on getting different levels of strategic partnerships and whatnot. So it's, that in itself is risky, right?
True.
So I would have added, let's say you put a 40% likelihood of achieving this level of revenue in the next year, and you freeze it down over the next couple of years, and you get a valuation based on that, and then you kind of look at, okay, what are other companies like this trading at right now? But that's tricky in the tech space, because the tech space is kind of hot. You see a lot of overinflated multiples in the tech space. So, I mean, it gets really nuanced and tricky. And what I like to do, especially when you're looking at comparable company valuation or comps or what have you, I want to discount the company I'm valuing based on, well, first of all, because it's a private company, so it's less liquid. And second of all, just what are the different features of this company that's different than that company? Is it making less money? Does it have higher operating costs? What makes it different than that company that might warrant a discount? So it gets very involved, but at the end of it, you have something that makes sense. And you always want to get to something that makes sense and something that you can defend. Defensibility is everything. It's everything, especially when you're talking to auditors, you're talking to the company or whatnot. Because companies get really passionate about their projections, right? I've sat in a room with a company, and they're like, "Well, Kevin, these projections are conservative." It's like, oh my god, and you also have to look at what's the purpose of the valuation. So if evaluations for a capital raise, you don't want to be overly aggressive with your projections, because the investors you're going to are going to be like, nope. They're going to discount them anyway. So I actually believe in almost under projecting and then over delivering.
So could you say that last part again?
Yeah, I actually believe in actually like scaling down your projections a little bit, and over delivering on your projections. Because especially if you're looking to raise capital, you wanna present it as an opportunity versus this is expensive. This is an expensive asset.
Gotcha. Well, that's very interesting. And I like what you said a couple of minutes ago as well too, that it keeps you up at late at night just thinking about, how do you deal with the concept or the idea of future growth. That's definitely something that because there's so much variability, and at the end of the day, you have to use your professional judgment, and you're putting your own name on the line, in terms of the valuation ratings that you ultimately come up with, when you publish, I guess, your report or your findings. So that's something.
Especially in a time like now, especially now when you have this COVID situation going on, and it's difficult to really forecast what you expect to happen 3 to 5 years from now. So I mean, a good baseline is looking at, okay, what is the expected growth rate of the overall economies that the companies are serving? It's difficult to. Well, anyway, let's just leave it at that.
No, that totally makes sense. For example, I recently saw an appraisal for a commercial piece of property, and the appraisal had a whole section on COVID-19, potential effects. So it has to be accounted for one way or another, because so much has happened because of COVID, right? I mean, supply chains have been disrupted. People could not go to work. Businesses were shut down. I don't know what it's like in Trinidad, but
yeah,
in some parts of the U.S., there are still lockdowns, and businesses, essentially can't operate, and hundreds of thousands of businesses ultimately are going to go under. They will never, they will not survive this, regardless of how much, money the government and the Federal Reserve here in the States, want to provide in terms of loans and so forth. But ultimately, especially a lot of small businesses, mainly restaurants and so forth, especially, they will not survive this. And so if you're valuing a restaurant, for example, I'm sure COVID-19 has affected you much differently than if you're a manufacturing facility, let's say, who maybe the supply chains that you rely on, the supplies you rely on in terms of whatever product you're putting together, maybe you've been affected, but maybe you're able to find other suppliers, domestic versus, suppliers in Asia, for example. So that type of valuation would totally have to, or an evaluation for that type of company would have to account for that. So it's very important for people to understand that, there's so many things that on your end as valuing a business that you would have to consider and look at. So I totally appreciate, what you just said.
Yeah. And I mean, I'll just add one other thing. I mean, I know this is probably going quite long, but I'll just add one other thing. So one of our biggest revenue earners and tourist attractions in Trinidad is our carnival season. That usually happens between January and March of each year. This year it's carnival season. So just for anybody who hasn't experienced carnival, it's a big street parade. You put on your costumes. You're very much in each other's space, and there's music trucks, there's drinks and everything. It's the greatest show on earth. It's literally the greatest show on earth, right? A lot of dancing, very high contact dancing, and all of that. Carnival has been cancelled in Trinidad this year. And so that is a huge blow to not only the party promoters and the event suppliers and everybody, but even just like what you mentioned, the restaurants, people who would have sold those extra food or whatever. You have the costume designers and all that. It's it's a big spin-off effect, and we don't know if it's going to be the same next year.
Wow, that's something I hadn't even thought about. Out of curiosity, do you know if anyone tried to quantify what the effect on the national economy would be because the carnival's been shut down? I assume it's going to affect the national GDP because you said it was such a big component of the economy there, right? Is it affected several percentage points, or I'm not sure?
Yeah, so don't quote me on it. I don't have the hard number, but I believe so. The revenue earned between that, let's say, 2 months or so, is typically around the 75 to 80 million US range, just in that period alone, which I mean may be small for a bigger economy, but for us, it's pretty significant.
Oh, I can imagine. And I
Yeah,
imagine that if next year, or actually I guess it would be this year, right, in 2021, that if you
hmm
had, if the carnival was put on, that it probably wouldn't be to the same level of, let's say, participation or people coming, you know,
yeah,
you know, to partake in it, and so that would still kind of hamper it. And perhaps it may take 2, 3 years for it to fully ramp up
exactly.
to the point
Yeah.
where people feel comfortable traveling and so forth.
hmm
That's a good point. That's something that, in the US, because we have, a very diversified economy, although we're very 70% consumer based, depending on what part of the region of the US you're in and what state you are, to various levels, they've been impacted, as a result of COVID. So um, on the business valuation, and what types of takeaways potentially could like the average retail investor take from kind of like that type of like the valuation, discussion that we had? Is there any takeaways that you could recommend, for someone who's a retail investor and maybe looking at maybe making an investment decision, and regardless of maybe what industry or what business they're looking at, but what type of takeaways they could take?
Yeah. So, I mean, quite broadly, I'll just say make sure that you understand the business that you're investing in. A lot of people invest based on fads and trends. I mean, don't even get me started on that Bitcoin thing. I still don't really fully understand. I still really fully understand Bitcoin, right? But I would say never invest in something you don't understand. You need to understand where the money is coming from. So not only the revenues, right? But you need to understand how the company makes its profit, right? And yeah, I mean, so that's where I say in terms of understanding the basics of business valuation, understand where the revenues come from, understanding where profits come from, and do you think that those revenues and profits will be sustainable in the long term, right? And I mean, of course, you could get into other things like, okay, so do you trust the team involved there? Do you think that's a sustainable competitive advantage and all those other things? But yeah, at a rudimentary level, understand where the revenue and profits coming from, and make sure that you're comfortable that they will be there in the long term.
That's a good point, and you're right. When you said that a lot of people kind of invest in fads, and I guess a lot of that also kind of boils down to the way I've seen it for many, many years now, is that many people are making investment decisions based on what they see everyone else around them doing. And so they can kind of get caught up in that euphoria, especially when they see Tesla stock or whatever it happens to be going up, through the roof.
Yeah.
And then all of a sudden they decide, oh, well, if it's been going up, then I got to get involved in it too. It's the, what they call it, the FOMO, right? The fear of missing out, right?
Mhm. Yeah.
And so,
Yeah.
and so instead of kind of like you said, taking more of a longer term approach, because I mean, you got to ask yourself, like, Tesla's done very, very well, in terms of the stock price for a number of years now. And you got to wonder, like, well, although it's gone up, I don't even know on this, so I'm just throwing this out there. Let's say several 100%, or maybe it's in the thousands of percent, depending on when you got into it, how many years
Mhm.
ago. And then you got to ask yourself, like, okay, well, if that's what's happened, if I get into it now, is there still that potential to increase
Exactly.
several thousands more percent, or maybe even several hundred more percent from here? And I don't think people really quite look at it that way. They kind of just feel like, oh, I don't want to miss the party. And
Yeah.
and
Oh,
so,
sorry.
so go ahead.
No, just gonna say that's why, and it goes back to the fundamentals of valuation that I spoke about earlier: growth and risk. So, do you think that the growth has been priced in to the current price? You know, if not, then sure, go ahead. If so, then let's just let us see how things happen.
Yeah, for sure. And it's something that, like, on the topic of like this show, although we talk a lot about alternative assets and alternative investing, we also talk a lot about, making intelligent and rational investment decisions as much as possible. And yeah, sometimes new technologies like cryptocurrency and blockchain and so forth, it's hard to, quantify or to estimate, projected growth. And, especially since there's, I think probably 2,000 or more cryptocurrencies at this point. Obviously there's several or a handful that are really well known that, quite a number of people, know in terms of the name, but do they understand what it actually does and how, what types of value it could perhaps bring, to investors or bring to the marketplace. So, and even then, I don't know if really a lot of people really quite understand it to that level. And at the end of the day, right, there's risk in every investment.
Yep.
You can't get around that, but it's a matter of at least understanding what the risks are. And I think for most rational investors, they'll try and minimize those risks, and at the same time trying to figure out ways of mitigating them if possible. So yeah, that's one of the themes of this show. So I'm glad we actually kind of had that discussion about risk, because that's something very important, and I hope that more people kind of like consider that. And maybe for the retail and average retail investor, they can't do the quantitative type stuff that you do on the risk side, but they can qualitatively in their mind mentally, right, kind of formulate, like, hey, like this is a certain amount of risk, or this investment has various risks, and when I take all these risks together collectively, it kind of it makes me feel uncomfortable, and therefore it's not in line with their risk appetite, I would say. And so at that point, the rational person should probably step aside and say, you know what, it's gone up several thousands of percent. Maybe this is not for me to participate in.
Yeah.
So there's a types of like internal questions, I think people should be asking themselves. And, even if they can't sit down with an Excel spreadsheet and really get into the numbers of things, right? I mean, so this is probably a good takeaway, I would say. And I totally agree with you in terms of how the retail person should probably think about these things moving forward.
Yeah, definitely.
The other thing I want to touch upon too is we'd love to hear about your company and why you founded Become Investible, and please explain like what it does.
Yeah. Okay. I mean, so I could give you the nice pitch about what it does and stuff, but first I'll just give you a quick background. So, in my experience in working in a boutique investment bank and in private equity, we see a lot of companies coming to us looking for funding. However, we, we their business models aren't fully de-risked properly, and we see the holes in them where we know we can't expose our investor clients, right? However, we're not necessarily in the business of providing that advisory service to help them, to make their business better and more attractive. Our business is in selecting investments that generate return and, sharing those investments with our investor clientele. So I saw that gap in the market where the companies who are looking for funding, they don't know. They don't know what they don't know. They don't know what investors are necessarily looking for. All they know is that this bank told them no, this investor told them no, and the system is against them, right? So Become Investable serves to be that bridge. Again, it's focusing on the medium-sized companies, on what it is that needs to be put in place into your company to make it more attractive to investors.
Interesting. And so you'll basically help them in terms of, would that be building internal processes and, perhaps doing things maybe on their, would it be maybe more like on their accounting side perhaps? And do you mind getting into a little bit more detail
Sure.
on how you actually do that?
So how we work, so right, we have built out a diagnostic tool, an investability diagnostic tool, which evaluates your company's attractiveness to investors based on 6 metrics, right? The first metric being your human resources systems, or we call it your people, right? How strong is your team? How strong is your succession planning? What about your ongoing trading and on everything? So essentially, can you take 2 months away from your business to go vacation in Hawaii or California, wherever, and your business is still running as usual? Or is it that you are in charge for every last decision in your company and they're reliant on you? What is your human resources strategy in line with your business strategy? And then we get into your customers. How much insight do you have into your customers? So it goes a little bit beyond identifying your target customer, but how are you collecting customer feedback? Do you know how your customers actually feel about you? How do your suppliers feel about you? How do your bankers feel about you? Because all that matters, because those are the people who impact your business in terms of your revenue line and your cost of goods line, right? You look at your competitive advantage, right? So let's say you're a tech company or whatnot, do you have your intellectual property protected, right? Are you reliant on any customer for more than 10% of your revenues? Because that's a risk, and lots of small and medium-sized companies, they'll tell you they have about 3 or 4 customers that give them their revenues, and because the contracts and the revenues might be high, they feel good, we're in business, we're making money. But investor will look at that and say, but what happens if this customer decides that they're going to jam you on prices, or this customer decides they're going to source their product elsewhere? Then that's a big hole in your revenue base, right? So that's what investors look at, right? You got to look at your financial controls. So again, a lot of these smaller companies, you might see the CEO doubling as the accountant. He's preparing the projections or whatnot. They may not be preparing accounts on a regular basis. So it's almost like you're running blind. You don't actually actively know your numbers. So that sort of thing. And also in terms of having financial statements prepared. So your financial controls will kind of feed into your financial statement preparation. We call that, financial data. And also, if you're looking for bank financing, like, do you have collateral? Are you in the habit of preparing projections and whatnot? And then, you have to look at the unsexy thing, which is the corporate governance. How do you manage your management team and your board and your shareholders and everything? Because inevitably, your goal is to protect your shareholders' interest.
Oh wow, totally. And this is all built into your diagnostic tool, you said?
Yeah, so it's a diagnostic tool where we have a questionnaire that you fill out, and you're scored based on each metric, and at the end of it, you get an assessment report which shows where your gaps are, what you need to focus on. So you have the option of coming to us and saying, okay, well, here, these are my gaps. Would you help me fill them? We would assist where our skill set lies, and then we outsource the rest. So we'll work with HR, with human resource specialists. We work with corporate governance specialists and that sort of thing to help you get where you need to be. And even further beyond that, if we find that you are an investable entity, we get you to an investable state. We'll actually go to our network of institutional investors and present you to them. So it's a full it's a full service like that. We even write your financial proposal, your info memo, whatnot, and present it to investors.
Wow, that's pretty amazing. So obviously that fits in with the Become Investible, right? But, identify where your gaps are, identify where maybe some of your weaknesses are, solidify and strengthen them. And then, you help them get to the next level of that, potentially getting funding as well, too, to do whatever it is they're trying to do in terms of maybe like,
to grow your company to scale. To see.
Nice. So just to kind of wrap this up a little bit, I know you got a podcast. I'd like you to kind of share a little bit about your podcast with the listeners and kind of why did you start that and kind of maybe where the podcast is going.
Sure. Yeah, so the name of the podcast is called Caribbean Power Lunch. Started it, the idea came to me in 2017, officially launched in January 2018. So it started off as a podcast where we're just featuring the stories of Black Caribbean entrepreneurs, because all right, so I will start with the Caribbean, then I'll zone into Trinidad. So in the Caribbean, most of the islands, it's Black, the Blacks are the majority. However, the wealth is not necessarily within the Black community, right? In terms of, business ownership and everything, the top 1%, no, it's not necessarily within the Black community. And so especially in Trinidad, I found that, other communities, they would have these businesses, they pass it on to their children. And, you see that generational wealth cycling and everything, be the East Indian community, the Chinese community, especially the Syrian community. However, it was different in the Black community where we were taught more to be, to do well in school and get a good job. So it's almost like black business was like it's it's not something you see very, very often. The other day, we tried to list some of the top 10 black owned businesses in Trinidad. I think we got to 7 or 8, So it's, it's pretty tricky. So I wanted to highlight black entrepreneurship in Trinidad and the broader Caribbean, just kind of shed a light there. And, it worked out well. I mean, I was a little nervous about people thinking, oh gosh, is he a racist now? But, it's actually funny enough, like the first people to like it when I put it out was, a friend who's not black, a client who's not black, and even strangers who aren't black, and a lot of the people who follow it are not black, but because it does the podcast itself doesn't focus on being black. It focuses on business. It's just that, the speaker is a black entrepreneur. But in terms of where it's going now, so especially with the, the Black Lives Matter and every movement in the US and everything, black businesses have been getting a lot more attention and limelight. And I don't like to be doing what everybody else is doing. I like to pioneer. So what we want to do, we want to evolve into actually providing tips for businesses. So let's say in Caribbean parlance, you target may have been more people who might be thinking about starting a business. We want to evolve it into business people who are already in business, but just want to know how to make the businesses better or make it more investable. Yeah. So just trying to tie it nicely into the Become Investible ecosystem.
Nice. I like that. And it's kind of funny you touched upon the the generational wealth thing, and in some cultures or maybe in some groups, it's not as promoted or as kind of ingrained in the culture as it probably should be. Mm-hmm. And I kind of see that, in some ethnic groups where they're really big on that, and in other cultures, maybe not so much. And at the end of the day, I think everyone should be concerned, and it should be a priority, in terms of building that generational wealth, especially kind of where I see, in the United States, at least, the middle class continues to get smaller and smaller. And so it becomes even more important, where middle class families, have something in place, to leave to children and grandchildren, because I think the opportunities down the road, are they gonna lessen? We got a lot of financial issues, especially in the U.S., growing debt, government, personal, business debts all continue to increase. And so a lot more uncertainty moving forward. I think it's just more important that it becomes, and I like the way you said it has to become ingrained in the culture,
Mm-hmm. I have a question though, if you don't mind. You said the U.S. middle class is getting smaller. Is it because the middle class are actually graduating to the upper class, or is it that the middle class is some of them are downgrading to the lower class?
That's actually a really great question, and I'm actually going to be doing a series of webinars this year that it's going to actually address it's going to address that in addition to a couple of other things as well too. But we've been seeing this growing income and wealth gap in the United States, and a lot of that actually has to do with for example, like monetary policy and ultra low interest rates, and that leads to a whole host of things whereby there's a search for yield, right? And with ultra low rates, you can't keep money in the bank. Well, I mean, you can keep money in the bank, but you're not going to get really a return on it. And in real terms, right, you're losing money, right? You're actually negative, and when you look at it in real terms. And so what happens is there's all this capital that's trying to chase yield. And of course, because capital is also cheap, it also becomes easy for that capital to be speculated with, right? To invest in the stock market and so forth. And you see asset price appreciation, for example, like in commercial real estate, right? Especially income producing commercial real estate. So that capital, continues to go to, income. Mm-hmm. So income producing assets then appreciate, and you can see that being reflected in cap rates that become more and more compressed. And when that happens, those people that own assets, they benefit from that. Well, what happens when you look at, a lot of middle class people that are very asset poor, let's say, they don't own too many assets, so they haven't benefited from that asset price appreciation. And this actually gets into government and society and so forth. And you see a lot of social unrest, for example, in the US, but I would actually say that it's a lot of it actually is due to what's going on with monetary and fiscal policies in the U.S. more so than anything else. And I think it's a very complicated subject because at the end of the day, most people don't understand how money works. They don't understand central banking. They don't understand, how money is created and what central bankers actually do. And what does it mean when they have ultra low interest rates, for example. And I remember years ago when, the Federal Reserve, wanted rates to go lower. They were saying they were, I should say, they were putting out there or signaling that, they wanted rates to go lower, that rates would potentially be going lower. And, and they justify it by, well, if mortgage rates, for example, are if we make them lower, then that makes the cost of housing more affordable. Okay. But then what it also does is when mortgage rates drop, then what it also does is it makes, let's say, mortgages perhaps more available to people, but that also shoots the price of home prices up, right? I mean, that's the other part of it. You can't just look at, one part and not look at the second part. I mean, look at what's happened, for example, with the price of real estate in the United States and actually in many parts of the world. I think I read something last year where the home prices in Australia have been on a tear for years. And again, that just comes back to if you've owned assets, especially the more assets you've owned, the more you've benefited from these types of low interest rate policies. But if you're part of the middle class, or let's say you're part of the lower middle class that really doesn't own any stocks, and maybe all you own is your home, or maybe you don't even own your home. Maybe you're just a renter. Maybe you're recently out of school and you're saddled with student loan debt because the cost of higher education, at least in the U.S., continues to go up way, way, way higher than where the government quoted inflation rate, I should say, is going, or where it's been trending, which is more or less around 2%, which is what we're being told. But that's a whole nother discussion in itself.
Yeah, because I mean, is it really 2%?
Exactly, and it's not. That's just to cut the chase. It's really not. And in fact, that's part of. I've got some great graphs that actually show that, and I'll be highlighting that in a webinar series. That by the time this podcast goes live, I may have already done the webinar series at that point, but I will make it available perhaps on YouTube or other type of platform for people to watch after the fact. But yeah, so I basically want to tell this whole long-winded story, and there's a lot to it because at the end of the day, nothing is done or nothing can be viewed in isolation or in a vacuum. Everything is interconnected. What is going on with monetary policy, fiscal policy in terms of government spending, what's going on in our society, what types of changes are taking place, cost of higher education, for example, younger people going to college and getting degrees that did they really need, for example, and then ending up in six-figure debt, that you can never get rid of. Because if you file for bankruptcy in the United States and you have student loan debt, the student loan debt never goes away. So there's all these things that has to be considered. And long story short, and I've got tons of graphs to show that the middle class in the US is actually falling further and further behind. And it's becoming more of a have and have not type, bifurcated structure where the people at the top, let's see if you want to call them the 1%, who own lots and lots of assets, they have benefited tremendously over the last 10, 15 years or more. And then if you also combine this with other factors such as globalization, for example, and the competition for lower wages and lower priced products, and that's also affected for decades now in the United States, manufacturing jobs, for example, and the types of pay that factory workers used to get, which used to be very, very good. So anyway, I know that was a really long explanation, but there's a lot of factors. Right. Yeah,
you're right. I mean, I want to say last year. Every time I think last year, I'm thinking 2019 because it's almost like 2020. It just never happened, right?
Yeah.
But back in 2019, when I was trying to advocate for private equity and put together a whole brochure, the first line I wrote is true wealth is ownership.
Yeah, I love that.
Yeah, that's it. I mean, you need to own assets. You need to own good assets.
Yeah.
Because just like you're saying about cash, cash that's in a bank account is cash that's losing value because of inflation, is losing purchasing power. So especially where we're in the Caribbean here, where our main currencies are softer currencies. When it comes to devaluation and everything, it's just losing even more value.
Totally. It's unfortunately, I don't know if you know who Robert Kiyosaki is, but he was one of the first people that many years ago, kind of enlightened me, when I read some of his books, many years ago, and he talks about this all the time too, that people they have no financial education. And I think if people understood, or had stronger financial education, I venture that we would not be in the position we are, because I don't think that a lot of people would stand for it or allow for it, to be honest with you. But they don't understand it, and so, there are many great quotes that I've heard over the years that that's the system likes it that way, right? Because then people can become more controlled and manageable in terms of the decisions they make, right? Because how can you make informed decisions when you're not informed?
Exactly. And listen, the wealthy, they make a lot of money off the uninformed. We speak about Bitcoin, right? People are pushing up the price of Bitcoin because they're buying it and they don't understand, right? So the people who understand what they're doing and got in early is like, okay, great. This thing is so overvalued. Let's sell right now. It's millions.
I know. Well, we can go on for hours, or maybe we'll have to do another show on this topic. But Kevin, please, can you tell the listeners how they can contact you and find out more about you as well too?
Sure. Pretty easy. You could go to kevinvalley.com. I'm also pretty active on LinkedIn. I don't want to give you too much instructions, go here, go there, go everywhere. But just check kevinvalley.com. That's a good place to kind of find me everywhere. And then, LinkedIn and various social media platforms.
Yeah, and we'll and Kevin will provide that information to me, and we'll provide it in the show notes as well too. Kevin, thank you for coming on the show today. I really enjoyed your time, and you provided a ton of value to the audience. Thank you so much.
Thank you for tuning in to this week's show. If you are interested in learning how alternative investments can help you build purpose-driven wealth, sign up on the High Rise Capital website to receive our monthly newsletter and free investor ebook. Lastly, if you enjoyed this episode, don't forget to subscribe and leave a 5-star review. Thank you for listening to Purpose Driven Wealth, the podcast for empowered investors.